Welcome to this explainer. Okay, I am so excited to have you here. Today, we're diving into cost accounting. Now hold on, before your eyes glaze over, let's completely toss out the idea that this is just some dry back-office math exercise. It's really not. What we're actually talking about today is building, calibrating, and tuning the literal financial engine of your business. We're going to zoom right in on Phase B, inventory management, that exact critical moment when costs finally attach to the products you're actually making.
Picture this for a second. Your supply chain team, they absolutely nailed it. Phase A is totally complete. The materials have entered the building, they're valued at their exact landed costs, and they're sitting right there on the factory floor. But here is the massive challenge. Knowing your landed cost is entirely useless if you don't know how to attach it to the final finished product. I mean, how do you measure the true cost of turning that random pile of raw materials into a product you can actually sell? Well, that is exactly what Phase B is built to solve.
So here's our roadmap for this explainer. 1. Attaching cost to products. 2. The 3 costing systems. 3. Developing standard costs. 4. Setting up ABC. And finally, number 5. The annual cost update. All right, let's just dive right into this.
Starting off with Section 1, attaching costs to products, your Phase B setup.
This right here is the critical juncture where theory meets the actual assembly line and costs finally map to the physical items you're pumping out. A huge takeaway here is that Phase B isn't just something you can wing on a day-to-day basis. You just can't. It requires a formal costing system. This system literally dictates exactly how manufacturing costs are accumulated and assigned. And so, the absolute crucial point is this. This is a one-time setup, generally done right at company formation. It has to be selected, documented as official accounting policy, and fully approved by your controller, CFO, and leadership before the very first production run ever begins. You simply can't start the engine without deciding how it's going to run.
Moving right along to Section 2, the 3 costing systems, also known as choosing the right engine.
So, as advisors or managers, we have to understand these distinct systems because, well, they serve completely different manufacturing environments. The first engine you can choose is called job order costing. You're going to use this when your products are unique, custom-made, or produced in really small, distinct batches. Think of construction companies, custom furniture builders, print shops, or even professional services. In this world, costs aren't accumulated by the week or the month, they are tracked specifically per job, right there on a job cost sheet. That sheet tallies up the direct materials, direct labor, and overhead for that one specific project. So in this environment, your work-in-process inventory, it's really just the sum of all your open job cost sheets sitting on the desk. Now, engine option 2 is process costing, and this is the exact opposite of a custom job shop. You fire this one up when identical units are being churned out in a continuous mass production flow. We're talking oil refineries, chemical plants, food processing, or making paper. Instead of tracking a specific, unique batch, costs are accumulated by a whole department over a certain time period and then just averaged out. Basically, you're trying to figure out the cost per equivalent unit. And depending on how you want to value things, companies will either use FIFO for a really pure look at current period costs or a weighted average to blend prior and current periods altogether. And honestly, this brilliantly illustrates the divide. Job order is for those unique, special batches tracked individually, while process is for that continuous mass production tracked by a departmental average over time. Your choice here depends entirely on whether your factory floor looks like a bespoke artisan workshop or a continuous, nonstop pipeline. Now, those two systems really form the bedrock of a manager's toolbox, but there is a third option, one designed for some very specific edge cases. It's called activity-based costing, or ABC. With ABC, the unit of accumulation isn't the job, and it's definitely not the department. It's the activity itself. This system is custom-built for companies dealing with incredibly diverse product lines and really, really high overhead. So, why does ABC even exist in the first place? Well, I want you to ask yourself a tough question. Are your high-volume, simple products secretly subsidizing your low-volume, super complex ones? You see, in traditional costing, you might just use a single overhead rate across the board. But if you have wildly diverse products, that single rate is going to create some massive distortions. Your simple products get penalized with overhead costs they don't actually use, while your complicated products, they end up looking way more profitable than they actually are. ABC was invented to fix that exact distortion.
Which brings us to Section 3, developing your standard costs. Time to calibrate the engine. All right, once you've picked your system, you have to calibrate the engine using standard costs. Think of these as predetermined targets that represent what a product should cost under perfectly normal, efficient operating conditions. A standard cost card is basically the foundation of all your budget comparisons and inventory valuation. It brings three key elements together. First up, your standard material cost, which is just your bill of materials multiplied by the expected purchase price. Simple enough. Second, your standard labor cost, figured out through industrial engineering time studies, then multiplied by your standard labor rate. And third, the predetermined overhead rate, or POR. This is your total budgeted overhead divided by whatever your budgeted allocation base is, like machine hours or labor hours.
Now, pay attention here, because the golden rule for your predetermined overhead rate is this. Your choice of the denominator directly shapes your volume variances. If you choose theoretical capacity, meaning you're assuming maximum possible output with absolutely zero breaks or maintenance, you're going to create massive volume variances every single time because, let's face it, that's impossible to maintain in the real world. Practical capacity adjusts for expected downtime and is usually the one most companies prefer. Normal capacity smooths things out over a few years of data. And budgeted? Well, that only works perfectly if your actual output identically matches your master budget. So seriously, choose this denominator carefully.
All right, Section 4, Setting Up ABC. Let's do an activity-based costing deep dive.
We touched on activity-based costing just a minute ago. And yes, it is definitely more complex to maintain than your traditional volume-based systems. But it's highly accurate and absolutely worth the effort when overhead takes up a massive slice of your financial pie. So let's walk through how you actually set this thing up. Step 1. Identify all your significant activities. We're talking machine setups, quality inspections, materials handling, stuff like that. Step 2. Assign your overhead costs into those specific activity pools. Step 3 is the critical one. Identify the cause drivers that have a legitimate cause and effect relationship. For instance, the number of actual inspections drives the inspection cost. Makes sense, right? Finally, Step 4. Calculate your activity rates and assign them to the products based on their actual consumption. This completely ensures that a complex, low-volume product that requires, say, 5 complicated machine setups actually bears the financial weight of those 5 setups, rather than just unfairly spreading that cost onto high-volume, easy-to-make products.
And that brings us to our final section, Section 5, the Annual Cost Update. Let's talk routine maintenance.
Just like a physical engine, you cannot run a costing system forever without doing some crucial routine maintenance before a brand new production year kicks off. I really want to deliver a stark warning here. Standards cannot go stale. Seriously, if input costs, labor rates, or factory efficiencies are shifting around in the real world, but your accounting system is just staying exactly the same, you are effectively destroying your ability to control the business.
Standard costs absolutely must be formally reviewed and updated a minimum of 1 time per year. No exceptions. Never, ever let a new production year start without checking your standards.
So what does that workflow look like? Well, for that annual update, you've got to do a material review to check your expected supplier pricing against actuals. You do a labor review for any recent wage shifts or productivity bumps. You completely recalculate your predetermined overhead rate based on the new budget. You update the bill of materials for any engineering tweaks made over the last 12 months. And most importantly, you assess the financial impact. Your finance director and CFO must sign off and approve any material changes before they are loaded into the system. And remember this key point. Standard cost changes are prospective. You don't go back and restate the past, you update the system to reflect reality for the future.
To wrap things up, I want to leave you with a somewhat provocative thought to apply to your own operations. Take a look at your variance reports this month. If you're seeing massive variances and you know you haven't updated your standard costs recently, are those reports actually showing you bad performance on the factory floor, or are they literally just showing you bad math? A pristine costing engine gives you the truth, plain and simple. An outdated one just gives you noise. Thank you so much for joining me on this explainer today. Take a really hard look at your standards this week, and as always, keep learning.